Welcome to the deep dive. Today we're diving into the story of really a giant. A giant in the world of finance and philanthropy. That's Warren Buffett.
Yeah, Warren Buffett.
He's got an estimated net worth of, get this, $149.6 billion as of February 17th, 2025.
Wow.
It's just unbelievable, right?
Right.
That makes him the seventh richest person in the entire world.
Yeah.
And of course, everybody knows him as the chairman and CEO of that massive company, Berkshire Hathaway.
Berkshire Hathaway, of course.
But, maybe you're listening to this and you want to get a quick grasp on, well, who is this guy? What made Warren Buffett? What's his background? What are some of his ideas about investing?
Right. The fundamentals.
Yeah, the core principles. But you don't want to get bogged down in a million little details.
Yeah, you want the essence.
That's what we're going to do today. We're going to try to give you that in this deep dive.
Definitely.
We've gone through a ton of material about Buffett, and we've tried to pick out the most insightful, most interesting stuff to tell you about. So we're going to go from his early life as, a kid growing up in Nebraska,
Right.
all the way to him becoming the investment legend that we know today. So we're going to explore his early life, his education, how his career developed, talk about his core investing philosophy. We'll get into some of the personal details of his life.
Yeah.
And, talk about the huge impact he's had on philanthropy.
It's a big story.
Yeah. Okay. So let's unpack this incredible story.
That's good.
All right. So where do we begin?
Well, I guess we go back to the beginning.
Right.
August 30th, 1930, Omaha, Nebraska.
That's where it all started.
That's where Warren Buffett entered the scene.
Wow.
His father, Howard Buffett, was a U.S. congressman and a businessman. His mother, Layla Stahl Buffett.
Okay.
And even as a young kid, Buffett, you could just tell he had this real interest, this spark for business and investing.
Yeah, it seems like it came really early for him. And there's this story about a book that he read when he was just 7 years old. It was called 1,000 Ways to Make $1,000.
Really?
Yeah, he got it from the Omaha Public Library. It's amazing to think that a book like that could have such an impact at such a young age. But from that point on, it seems like he just dove headfirst into every entrepreneurial activity he could find.
I guess when you're inspired, you're inspired. So what did he get up to?
We're talking about a kid who's out there selling chewing gum, Coca-Cola, those weekly magazines, door to door.
Oh, wow, the classic hustle.
Exactly. And he even worked at his grandfather's grocery store.
So like a real hands-on kind of kid.
Definitely. And this wasn't just a phase. He kept it up all through high school, delivering newspapers, selling golf balls and stamps. He even detailed cars for people.
So he had that business sense from a young age, always looking for a way to make a buck.
Absolutely. And get this, in 1944, when he filed his very first income tax return, he was only 14. He claimed a $35 deduction for using his bicycle and watch for his paper route. Even back then, you can see that incredible attention to detail, that meticulousness that's become so synonymous with his style.
It's like it was always there, right? Like embedded in his DNA.
Yeah. And his fascination with the stock market also started super early.
Oh, yeah?
He used to hang out in the customer lounge of this regional stock brokerage firm. It was near his dad's office.
Okay.
And his father really fostered that interest. He even took young Warren to visit the New York Stock Exchange when he was just 10 years old.
What an experience for a 10-year-old.
Can you imagine?
No, I can't even imagine.
Yeah.
So at what point did he actually start, dabbling in the market himself?
Well, believe it or not, he bought his first stocks when he was just 11 years old.
11?
Yeah. City Service Preferred, he bought some for himself and some for his sister Doris. She actually went on to become a big philanthropist in her own right, which is interesting.
Wow. Philanthropy runs in the family.
Yeah, it really does. And by the time he was 15, he was making over $175 a month, just delivering Washington Post newspapers.
That's pretty good for a teenager, even back then.
Yeah. And he wasn't just spending it all. He was investing that money, too.
Oh, are you?
He invested in a business owned by his father and even bought a 40-acre farm when he was 14.
A farm?
Yeah. He used $1,200 of his own savings. Talk about entrepreneurial spirit. By the time he graduated from college, he had saved a whopping $9,800.
That's a lot of money.
It is, especially back then. That's like having $130,000 in today's dollars.
That's incredible. What a head start. So tell me about his education. Where did he go to school?
Well, he actually started at the Wharton School at the University of Pennsylvania in 1947.
Okay.
he later admitted that he would have rather just focused on his businesses.
Oh, really?
Yeah, he wasn't super into the whole academic thing at that point.
Well, he already had a lot going on.
Yeah, and he eventually transferred to the University of Nebraska and graduated with a BS in Business Administration in 1951.
Makes sense. So was that it? Was he done with school at that point?
Well, this is where things get really interesting. So he applied to Harvard Business School.
Oh, wow.
Yeah, but they turned him down.
They turned down Warren Buffett.
Imagine that, right?
Wow, that's a bad miss for Harvard?
Huge miss, right. But then he discovered that the legendary Benjamin Graham...
Oh, of course, the father of value investing.
Exactly. Graham was teaching at Columbia Business School.
Okay.
And that was it for Buffett. It was like a light bulb moment.
A turning point.
He enrolled at Columbia. He got his Master of Science in Economics in 1951.
Wow.
And it was really at Columbia, studying under Graham, that he truly developed his core investment philosophy.
The roots of the legend.
Right. And just for kicks, his senior yearbook quote was, "Likes math, a future stockbroker."
Haha. And they say fortune telling isn't real. So what happened next? Where did he go from there?
Well, after all that education and with his head full of Graham's ideas, he went to work for his dad's firm, Buffett, Falk & Co. He was an investment salesman there from 1951 to 54.
Makes sense.
But then came the real game changer. He got a job as a securities analyst at Graham Newman Corp.
Oh, wow. So he was working directly with Benjamin Graham.
Yeah, directly under him from 1954 to 56. And his starting salary was $12,000 a year, which, back then wasn't bad. It's about $141,000 in today's money.
It's pretty decent.
Yeah. And just imagine the insights he must have gained working directly alongside Graham.
Seeing those principles in action every day. Yeah, I mean, that's an invaluable education.
Absolutely.
So what were some of the, the big ideas that Graham kind of, drilled into him during that period?
Well, one of the big things was this idea of a margin of safety.
Margin of safety, yeah.
It's basically buying a stock for a lot less than what you think it's really worth.
Okay.
So that gives you a buffer if you're wrong about the valuation or, if some unexpected bad thing happens.
It's like a cushion.
Exactly. And Graham also stressed the importance of really, digging deep, analyzing the fundamentals of a company rather than just getting swept up in the hype and the short-term swings of the market.
Makes sense. So was this around the time he started his own partnerships?
Yes. In 1956, when Graham retired and shut down his firm, Buffett, who had saved over $174,000 by then, he said, you know what, I'm going back to Omaha, and I'm starting my own investment partnership.
Wow, so that's how Buffett Partnership Ltd. was born.
Exactly. He launched with 3 separate partnerships in 1957.
Right.
And just a couple of years later, by 1959, he had 6 of these partnerships going.
Busy guy.
Yeah. And that same summer, he had this lunch meeting, and he was introduced to someone who would become absolutely critical to his success, Charlie Munger.
Oh, yeah. His right-hand man.
His partner in crime. And talk about a pivotal connection.
Yeah, that was a turning point.
And it wasn't long before Buffett started racking up some pretty impressive wins with these early partnerships.
What was, one of the standouts?
Well, his investment in the Sanborn Map Company really stands out as an example of his approach.
Okay, tell me more about that.
Well, in 1961, Buffett revealed that, get this, a full 35% of his partnership's assets were in Sanborn Map.
Wow.
Yeah. And he argued that the stock was trading at just $45 a share.
Okay.
But the company had this investment portfolio totally separate from their map-making business that was worth $65 a share.
Okay.
So basically, the market was valuing the actual map business at a negative number.
Oh, wow.
Which is crazy, right? But for Buffett, it was a classic example of seeing that huge gap between the market price of a company and its real intrinsic value.
I see.
So he took action.
What did he do?
He became what's called an activist investor. He didn't just buy the shares and sit on them.
Right.
He worked to influence the company's management to unlock that value.
Okay.
So he ended up buying 23% of Sanborn's outstanding shares, and he got a seat on the board.
Smart.
And then he teamed up with some other shareholders who were also unhappy with how the company was being run. And together, they controlled 44% of the shares.
Wow. So they had real power.
Yeah, they did.
Hmm.
And to avoid this potential battle for control of the company, the board made an offer to buy back their shares at a fair price using some of their investments.
Okay.
And a crazy 77% of the outstanding shares were turned in, which netted Buffett a 50% return on his initial investment in just 2 years.
Wow. That's the Buffett magic, right?
It's a perfect example of his value investing strategy in action.
So I guess this is where we move into the Berkshire Hathaway era.
This is where it all changes.
Right.
So how did that transition happen? How did he get from these partnerships to running this huge conglomerate?
Well, in the mid-1960s, Buffett started investing in this textile manufacturing company called Berkshire Hathaway. And he gradually acquired a controlling interest.
Okay.
He was buying shares from the owner, Seabury Stanton, and actually, eventually ended up removing him from his position.
Yeah.
So initially, his partnerships were scooping up shares for around $7.60 each. But by 1965, when they really started buying in bulk, the price had climbed to $13.86 a share.
Okay.
But here's the thing. The company's working capital, so basically their liquid assets minus their short-term liabilities, it was $19 per share.
Wow.
And that's not even considering the value of their factories and equipment.
So he saw even more underlying value.
Yeah, he saw that there was a lot more to be unlocked.
Okay, so he sees this potential, he sees this value,
Yeah.
and he decides to step in and take the reins.
Exactly. He took control at a board meeting in 1970,
Okay,
became chairman and the majority shareholder.
got it.
He even brought in Ken Chase to be president and run the textile operations, although Chase was later fired.
Oh, interesting.
Yeah, and by 1966, Buffett had closed the partnership to any new investors.
So it was really becoming his own thing at this point.
Yeah, his focus.
And, it's kind of surprising to hear, but Buffett later called his initial investment in that textile business his worst trade.
Really? That's surprising to hear from a guy with such a great track record.
You would think he'd have a Midas touch with everything.
Right.
So what do you think? What lessons did he learn from that experience that shaped his later decisions?
Well, I think it showed him that even with careful analysis, sometimes things don't go as planned.
Yeah.
And that it's important to be willing to adapt and change course if necessary.
Okay.
I mean, he didn't let that setback define him.
No.
Instead, he used it as a learning experience.
And he obviously had a bigger vision for Berkshire Hathaway.
Yeah, it wasn't just about textiles.
So what was the plan?
Well, he strategically shifted Berkshire's focus into the insurance sector.
Okay.
It was an area that he understood well. He saw its potential for long-term growth and stability.
Smart.
And eventually they sold off the last of those original textile mills in 1985.
So Berkshire Hathaway really transformed during this time.
Absolutely. And here's another interesting tidbit. Berkshire paid its first and only dividend, 10 cents a share, way back in 1967. And then in 1969, Buffett decided to liquidate his original investment partnership. He distributed all the assets, which included Berkshire Hathaway shares, to his partners.
So he was really all in on Berkshire Hathaway, and I read that after that, he lived solely on his Berkshire salary, which was a modest $50,000 a year, and income from some of his outside investments.
That's pretty incredible considering how much wealth he had at his fingertips. Okay, so let's dive into some of those key investments that really turned Berkshire Hathaway into the powerhouse it is today.
Okay.
I think we have to start with his investment in Geico Insurance. That was a huge early win for him, wasn't it?
Geico, yeah, that was a big one. And the story of how he got involved with them is amazing.
What happened?
Okay, so way back in 1951, Buffett discovered that his mentor, Benjamin Graham, was on the board of directors of Geico.
Yeah.
And Buffett was so intrigued that on a Saturday, he just hopped on a train to Washington, D.C.
Wow.
Yeah.
Just like that.
Yeah. And he went to Geico headquarters. He knocked on the door, but no one was around. But he kept at it. And eventually this janitor let him in.
He was persistent.
He was.
What happened?
He ended up having this long conversation with Lorimer Davidson, who was Geico's vice president at the time. And they talked all about the insurance business.
Okay.
And that meeting led Buffett to make his first investment in Geico stock.
Wow.
Davidson and Buffett actually became lifelong friends.
Really?
Yeah. And Davidson even said that he knew after just 15 minutes of talking to Buffett that he was an extraordinary man.
There you go.
Sometimes you just recognize brilliance when you see it.
You just know. So what other early investments were kind of pivotal for him?
Well, in 1973, Berkshire Hathaway started buying up stock in the Washington Post Company.
Okay.
And that move led to a close friendship with Katharine Graham, who ran the company. Buffett eventually joined the board of directors.
Okay.
Then, in 1977, Berkshire indirectly made a big splash in the media world by buying the Buffalo Evening News. So he was branching out, making some strategic moves.
Yeah.
Then in 1979, they started buying stock in the American Broadcasting Company, ABC.
ABC, yeah.
And then in 1985, there was this huge deal. Capital Cities Communications bought ABC for $3.5 billion.
Wow.
But here's the thing. Capital Cities was actually a lot smaller than ABC,
Really?
like 4 times smaller.
Okay.
And Buffett played a key role in helping to finance the deal.
Wow.
In return, he got a big 25% stake in the combined company, which was called Capital Cities ABC.
So that was his entry into the television world.
Exactly.
What about Berkshire's moves into the financial world? They've held some pretty big stakes in banks and investment firms.
Yeah. So in 1987, Berkshire bought a 12% stake in Salomon Inc., which was a major investment bank and brokerage firm.
Oh, yeah?
That made Berkshire the biggest shareholder. And of course, Buffett got a seat on the board.
Right.
Then in 1990, Salomon got hit with a big scandal.
Right.
One of their traders was doing some shady stuff.
What happened?
Well, it was bad. It almost brought the whole company down.
Wow.
So Buffett stepped in and became chairman of Salomon to help them through the crisis.
Wow. Talk about a steady hand.
And he stayed in that role until the crisis was resolved in 1991.
So he didn't shy away from getting his hands dirty when it was necessary.
No.
Okay, so what else was he investing in during this time?
Well, starting in 1988, he began what would become a massively successful long-term investment in the Coca-Cola company.
Coca-Cola, of course.
Yeah. He eventually owned up to 7% of the company's shares.
One of his most iconic holdings.
Yeah, definitely.
So, not every acquisition or investment is smooth sailing, right? Were there any, moves that presented some initial challenges for him?
Absolutely.
Okay, so what was one that kind of, maybe didn't go exactly according to plan at first?
Well, in 1998, he bought General Re, usually called Gen Re. It was a big reinsurance company.
Okay.
And it was meant to be a major subsidiary, but it had some problems from the start.
Oh, really? Like what?
Well, their underwriting standards weren't great.
Okay.
And they had this messy derivatives book that took years to sort out and resulted in a big financial loss.
Derivatives, always a headache.
It shows that even Buffett isn't immune to challenges.
Right. Even the best investors make mistakes or run into unexpected bumps.
And speaking of bumps in the road, remember Buffett's dealings with AIG?
AIG, yeah.
So Gen Re got involved in providing reinsurance to AIG after Buffett started working with Maurice R. Greenberg, who was AIG's CEO, in 2002.
Okay.
But that whole relationship ended up causing some serious legal and regulatory issues.
Oh, no.
It was messy, and Gen Re ended up having to settle with the U.S. government over the AIG case in 2010.
Wow, so even Buffett gets caught up in the occasional scandal.
It happens. So, beyond just buying and holding stocks, Buffett's made some pretty savvy financial maneuvers over the years.
Yeah, he's not afraid to think outside the box.
For example, in 2002, he made these massive forward contracts in foreign currencies.
Okay. How massive are we talking?
We're talking $11 billion worth.
Wow, that's a bold move.
And it paid off big time. By 2006, those currency bets had made Berkshire over $2 billion in profits.
Nice.
And then during the 2008 financial crisis, when everyone was panicking, Berkshire made a huge investment in Goldman Sachs preferred stock.
Oh, yeah. A real vote of confidence.
Yeah.
Well,
Well, he also helped Dow Chemical finance its acquisition of Rohm and Haas in 2008.
Okay.
And that deal made Berkshire the largest shareholder in Dow Chemical at the time.
Smart.
And then there were the investments in Swiss Re in 2009.
Swiss Re?
And in the same year, he made that massive $34 billion acquisition of the Burlington Northern Santa Fe Railroad.
The railroad, wow.
Yeah.
So, even Buffett has made some decisions that haven't worked out quite as well as he'd hoped.
Yeah, for sure. Nobody's perfect.
Right, no one bats 1,000. So what's an example of that?
Well, in 2009, he admitted that he'd made a mistake with ConocoPhillips.
The energy company.
Yeah. He'd bought a ton of their stock when oil and gas prices were at their peak.
Okay.
But then, of course, prices plummeted, and he ended up selling his stake at a loss.
Tough break.
Yeah, he called it a poorly timed investment.
It happens.
Yeah. And then, for years, he avoided investing in tech companies. But then in 2011, he started buying IBM stock.
Oh, yeah. He was famously hesitant about tech.
Yeah. but he was willing to adapt his approach over time.
He clearly saw something in IBM.
Yeah. And then in 2012, he went even deeper into the media world with the purchase of Media General's newspapers.
More newspapers.
Yeah, he was buying them up through Berkshire Hathaway's BH Media Group.
So he wasn't afraid to go against the grain, even when everyone's saying print media was dying.
Right.
What about that regulatory fine in 2014? What happened there?
Oh, yeah. Berkshire got fined $896,000 because they didn't report a purchase of USG Corporation shares on time.
A technicality.
Yeah, technical violation.
Yeah.
And then more recently, in 2023, there was this ProPublica report that made some allegations about Buffett's personal stock trades.
Oh, yeah, I remember reading about that.
They claimed that he was buying and selling shares in companies around the same time that Berkshire Hathaway was involved in deals with those companies.
So they were implying a conflict of interest.
Right.
Yeah.
But Berkshire's vice chairman, Charlie Munger, he completely dismissed the allegations.
Okay.
He said they were unfounded. So we've talked a lot about, the specific investments that Buffett's made and some of his big moves, but I think it's important to step back and look at the underlying philosophy that's guided him all these years.
Right.
What are the core principles of his investment approach?
Well, as you might guess, it all goes back to that value investing approach that he absorbed from Benjamin Graham.
Okay.
The basic idea is you find fundamentally sound companies that are undervalued by the market.
Okay.
So you're looking for companies with good management, strong financials, and a solid track record.
Right.
And then you wait for their stock price to drop significantly below what you think the company is actually worth.
Okay. So you buy when everyone else is selling.
Exactly. And that's where the margin of safety comes in.
Right. That cushion.
Right.
So you're protecting yourself in case you're wrong about the company or if something unexpected happens.
Exactly. And Buffett has always been a long-term investor.
Yeah.
He's not interested in quick flips or chasing the latest trends.
He's in it for the long haul.
Exactly.
And he's really not afraid to go against conventional wisdom.
Yeah, he's often been called a contrarian investor.
In 1984, he wrote this famous article called The Super Investors of Graham and Doddsville.
Oh, yeah, classic.
Yeah.
What was it about?
Well, in it, he basically challenged the efficient market hypothesis.
Oh, yeah, the idea that market prices always reflect all available information.
Right.
So you can't really beat the market.
Exactly. But Buffett argued that the success of all these investors who followed Graham and Dodd's value investing principles, their success wasn't just luck.
Okay. It was because they had a sound and repeatable method.
So they were finding these pockets of inefficiency in the market.
Exactly.
And exploiting them.
Yeah.
And Buffett's also been pretty vocal about the need to have realistic expectations about stock market returns, hasn't he?
Oh, absolutely.
Yeah.
In 1999, he wrote this article for Fortune magazine where he basically warned investors that the incredibly high returns of the previous 17 years weren't going to last forever.
Okay.
And he even gave an estimate for what he thought the market would return over the long term, around 6% per year.
Okay.
And he based that on things like interest rates, inflation, and the cost of trading.
So a much more grounded perspective.
Yeah.
So how does that relate to his views on, things like index funds? Because I know he's a big fan of those.
Oh, yeah. Index funds have become a huge part of his message to the average investor.
Okay, so what's the deal with those?
Well, he's a strong advocate for low-cost index funds, especially those that track the S&P 500.
Okay.
He thinks they're the best way for most people to invest. Why is that?
Because he's super skeptical that most actively managed investment funds, those run by professional money managers,
Yeah.
can consistently beat the market,
Okay.
especially when you factor in all the fees that they charge.
Right. Those fees can really eat into your returns.
Yeah. And he famously made a bet in 2007. He bet $1 million that a simple S&P 500 index fund would outperform a group of hedge funds over 10 years.
No, yeah. I remember hearing about that. What happened?
The index fund won by a landslide.
Wow.
So the takeaway is, for most people, keep it simple, diversify broadly, and keep those investment costs low.
The Buffett way.
And, when it comes to Berkshire Hathaway's own deals, Buffett generally avoids using investment banks.
Oh, really? Why is that?
Well, he just doesn't like them.
He's not a fan.
Yeah, he prefers to negotiate directly with the other parties.
Okay.
He thinks it saves money and gives him a more